Okay, hi everyone. This is going to be the first lecture here for chapter 25. We're looking at transfer taxes and wealth planning. So just a kind of overview of this chapter, right? It's not my favorite chapter to teach. The reason for it is unless you really specialize in this, we're going to see this isn't really applicable to a lot of people, right? So we're talking about the federal estate and gift tax, and we will see, right, there's this exemption equivalent and applicable credit. And in short, right, if I were to summarize kind of this whole chapter in like 10 seconds, I would say, okay, let me explain this like kind of long, complicated thing to you. And oh, by the way, unless you give like, roughly $12 million in gifts throughout the combination of your life and death, this isn't even going to apply to you. So it's like less than 1%, probably like 0.00 whatever percent of the population this is actually going to apply to. But right, you could have them as your client, right? It is possible, right? These really rich people need tax services, but this is part of it, and we will talk about all of it. But that's kind of my like intro here to this. So right, the saying is there's nothing sure in life but death and taxes. Here we're kind of combining both, right? Taxes at death, right? So we look at the history, right? 1916, Congress, they impose an estate tax on transfers of property at death. These are going to be known as testamentary transfers. So if it's a death, it's a testamentary transfer, right? Your last will and testament. In 1924, they expanded the system to include gifts during one's lifetime, right? So if you make it during your lifetime, it's called an inter vivos transfer. Eventually, they did create the GST, the generation skipping tax. This was meant to kind of close up a loophole and prevent people from transferring assets to younger generations. We'll talk about that on the back end of the lecture. But in any event, right, the combination, these three taxes, the estate tax, the gift tax, the generation skipping tax, they are known as transfer taxes, right? Essentially, hey, you have person A who's transferring some type of property to person B, whether it's at life or death, and we are going to impose a tax on that on here. So it says the estate and gift tax originally were separate from each other. However, in 1976, they unified these into a single transfer tax formula that applies a tax rate schedule to cumulative transfers. This formula, right, it considers cumulative lifetime transfers in previous periods when calculating the tax on a gift in the current period. Likewise, the integrated formula considers testamentary and lifetime transfers to compute tax on assets transferred at death, right? What does this mean? Right, once upon a time, they were kind of separate taxes. Then kind of like the infinity gauntlet, right? They unified them into a single schedule. When they look at and they determine whether you're subject to this tax, it's really almost like a historical view, right? What did you give in the current year, whether you were alive or you died in the current year? What did you give at your death? Plus, what did you give in all the prior years, right? So they're kind of unifying, looking at it from this historical perspective. One big thing here, right? I told you, we have this giant credit that whenever we look at that like format, right, these like cumulative gifts, we will figure out the tax liability on it, right? Hey, maybe you owe, $50,000. Most of the time, right, we're going to have a giant credit that's going to offset that down to zero, right? So that's what it says here. The applicable credit reduces the number of individuals subject to these taxes. In short, right, the maximum amount of taxable transfers a person can make without exceeding the applicable credit is called the exemption equivalent, right? So it's kind of like if you think about, hey, you make $100, right, income, that's going to create a $20 tax liability, right? Here, the exemption equivalent is basically saying how many gifts, right, X, can I give during my life such that, in my lifetime, such that it creates the applicable credit. If we go back to the definition section, I have some definitions back here if you want to look at these. But essentially, the exemption equivalent is roughly $12 million, right? I'm pretty close to 13 there. And let's see if we can find it here, the applicable credit, $5 million. So there's a relationship between this. In other words, $12 million in taxable gifts generates a $5 million tax liability. In other words, what we're saying is, hey, during your life plus your death, you can give up to $12 million in gifts. Stated alternatively, if you do that, up to 12 million generates the credit for you, $5 million. If you give more than that $12 million number, this credit is gone. It's maxed out, right? You don't get it anymore. You've used all of it. So we kind of have a little framework here, right? So we have the donor, that's the person making the gift, right? In this kind of unified system, right, we're going to look at their annual gifts during their lifetime. We will see, right, we're going to define what is a gift, what's not a gift. You get an annual exclusion each year. It's like roughly $17,000 per person. The leftovers on that, right, that's going to be essentially your taxable gifts. Right, we'll talk about the difference between gross gifts and taxable gifts, but that's essentially for the current year. You combine that, right, when we're looking at this kind of format here, because it's a unified system, we basically are going to look at what you did in the current year, whether you gave gifts or you died, right? Whatever you gave in your will or during the current year, plus everything you did in the past, right? All the previous years you had, gifts on there, right? So that's kind of the combination how this comes into play here. We'll look at it more specifically. So we're going to start with the gift tax, right? The federal gift tax. Then we will talk about the estate tax, and we'll kind of see how they're unified into each other, right? So the federal gift tax, right? So we're talking about federal level taxation. Generally, you're not going to see a state level estate and gift tax. One exception is Pennsylvania. Pennsylvania does have an estate tax. And it's like a flat percentage based on your relationship to the person who's getting it, right? So if like dad passes away in Pennsylvania and gives $100,000 house to son, right? Son might have to cough up like 6% of that, 7% as an estate tax. In that case, right, the person receiving the gift is going to have to pay the estate tax. But generally, when we're talking about the federal gift tax and the federal estate tax, this is at the federal level. And if there is a tax liability associated with it, the donor, the person making the gift, is going to be the one paying the tax, right? So paid by the donor, not the donee. Different at the state level on there. So essentially, if you have taxable gifts in a given year, that is to say they exceed this annual exclusion, you're going to have to file a Form 709, right, a gift tax return by 4/15. And essentially on this return, you got to be aware of, yes, because a lot of times there are people like, well, I can't give a gift more than 17,000, right? Because if I do that, I'll have to, file a gift tax return. Well, that is true. You do have a filing requirement if you exceed this annual exclusion we'll talk about. But just because you have a filing requirement does not mean you're actually going to owe any tax on it, right? We have this giant credit, this like $5 million credit that can offset all of your gifts you give during your life and at your death, right? So yeah, you have a filing requirement, but that's more honestly for record keeping purposes so they can keep track of it if you're in the 0.001% who's going to give more than 12 million in gifts. Right? So if we were looking at The 709, that simplified gift tax return, right? You're going to start with your gross gifts, right? We're going to talk about things that are not gifts, right? So if it's an incomplete gift or there's kind of strings attached to it, political contributions, transfers subsequent to a divorce. If you pay another's medical or education expenses and you pay it directly to like the hospital or the college, right? Those things don't count as gifts, right? That's kind of the first point. What is not a gift? Then we're going to say, okay, um, we know what is not a gift. Then we're going to define a gift, which is essentially a detached and disinterested transfer of property, right? Once we figure that out, right, what are our gifts, right? Then you get to back out an annual exclusion, which is essentially $17,000 per year per donee. Donee is the person receiving the gift, right? So, hey, maybe I had and I made two $20,000 gifts, right? Those would be my gross gifts of $40,000, right? 20 plus 20. And I made those gifts. Hey, maybe I gave $20,000 of cash to Jack, and I gave $20,000 of cash to Jill. On each of those, right, I get to back out $17,000, right? So not even talking about any deductions yet. My taxable gifts are going to be $6,000, right, for there. Okay, so that's the annual exclusion. Deductions, right? We'll talk about this. You get a deduction for any, marital gifts, right, between spouses. Hey, husband gives wife a gift, and you also get a deduction for gifts to charities, right? That ultimately is going to get us from our gross gifts to our taxable gifts during the current year, right? So we look at what we did in the current year. We're going to add to that any prior year taxable gifts, right? That'll get us our total taxable transfers to date. Multiply that times the rate. Give us our tentative tax liability. Back out any tax liability on taxable prior year gifts. Back out, the big one here is the applicable credit, right? This is like if somebody said to you like, oh, I gave a $20,000 gift, right? I'm going to have to file a gift tax return because I exceeded. Yeah, maybe you may have like, $2 here of a liability, but you have this $5 million credit that you can use throughout your life. So this is like the thing where it like wipes it down to zero. That will get you to your overall tax liability. So we will see this kind of interplays with the estate tax if, later point in time. So that was the simple version. Here's kind of the more complex version, how you would see it on the form, how the book presents it there. But let's talk about this, right? First off, what is a gift, right? So a gift is essentially a lifetime transfer of property. All right, it's made out of detached and disinterested generosity. And essentially, right, there can't be any conditions on it, right? Like if mom gives son $20,000, right, for getting straight A's in college, that's not a gift, right? That there's consideration. Like if you do this, then that happens, right? That's like quid pro quo. Can't have that for gifts, right? It's just here, son, here's $20,000, right? No strings attached. The other thing too is, right, the donor has to relinquish control of the property. In other words, when they give that gift over, it's now the other person's. They can't take it back, right? We will see, right, if there's like a revocable trust, right? We put property into a trust, and then, we say, oh, okay, at any point we can pull that back. Well, that's not a gift, right? It has to be when we give it away, we truly give it away, right? So in those kind of situations where the donor retains control over it, that's going to be an incomplete gift, right? If they're able to kind of pull it back, or if they don't get everything, like all of the kind of possessions or indicias of ownership, right? So like a life insurance proceeds, if you want to give that as a gift, right, like a life insurance policy or proceeds, you got to give them everything, including the ability to pick who's going to be the beneficiary. All right, so if we look here at 25.1, we have on 6.1, we have a taxpayer who transfers $250,000 of stock to a revocable trust, right? So they're like, hey, we're going to put 250 grand into a revocable trust. And revocable means it can be pulled back, right? And per the terms and conditions, right, this trust is to pay taxpayer 3, right, another guy over here, $20,000, or no, it's just, it's going to pay them money for the next 20 years, right? Is this a gift from taxpayer 1 to taxpayer 3? Well, the answer is no. The reason being is when this money is sitting in the revocable trust, at any given time, that taxpayer can ask for it back, right? They can get it back. They haven't relinquished full control in this situation, right? So you can see the other examples there where they kind of modify this so control is relinquished, but that's example 25.1 on there, right? A couple things here, right? Most gifts are going to be obvious, right? Here's some cash, here's some property. There are some special situations we have to be aware of, right? One of them here is a joint tenancy, right? So when we talk about tenancy, we're usually talking about some type of property, right? Maybe like a house or land or something like that. And joint tenancy would be something like when there are 2 tenants or owners of that parcel of land, right? So if we have a situation, right, where there's joint tenancy, right, that this guy owns 50% of that and that girl owns 50%, right? If whenever they go to buy this, one of them, like this guy right here, is like, look, I'm going to give and pay 75% of that, right? Say the house is 100,000, right? And they're like, look, let's go in on this together. We're going to be 50-50 owners. He will pay 75 grand and she will pay 25%, right? Or 25 grand, right? So here's the deal. We each are 50-50 owners of this, but this guy paid more for his equal ownership. That difference there, that's going to be a gift from him to her on there, because essentially they're both getting the same thing, the ownership, but they're paying different amounts for it. It's almost like he took on some of the responsibility for her paying. Likewise, right, say it was something like, the yellow guy is like, look, we're going to be 50-50 owners, and I'm going to pay the entire 100 grand on this, right? In that case, right, she's going to have like, another gift there, right? This is a gift to her. So let's look at 25.2 to kind of show this. All right, so we have taxpayer 1, they help to buy a house for a husband and wife, right? So taxpayer 1, he's saying, look, you guys right here, husband and wife, I'm going to help you guys buy a house. And essentially what's going on is taxpayer 1 and taxpayer 4, right? So let's just say this is like father-in-law, this is husband, and this is wife, right? So father-in-law says, look, daughter, me and you are going to go in on this house. We're going to be 50% owners. It's a $250,000 house. Father will pay $210,000 and daughter, wife, will pay $40,000. Each of them will get a 50% ownership in this. What's going on here is father is essentially giving a gift to daughter, wife. In this case, it's not his wife. I'm just going to put D for daughter, right? Essentially, if you think about it, right, it was 250 grand, right? Which means a 50% ownership should be worth 125 grand, right? That's like the fair value of that 50% ownership, right? So in this case, right, she got something worth 125, right? That's what she got, but she only paid 40 on that, right? So the difference there, that 85 between those two, that is considered the gift from father to daughter, right? So just kind of showing you sort of an iteration there of a gift or a setup on it. So we talked about what are gifts, what are not gifts, right? So if the donor keeps control, right? Let me get rid of that space there. So that would be an incomplete gift, right? That revocable trust. Likewise, political contributions are not gifts, right? You make a donation to the Trump campaign, that's not a gift. Payments of another's medical or educational expenses are not a gift if, and the operative word here is they are made directly to the healthcare provider, so like the hospital, the doctor, or the educational institution. What does this mean, right? Let's compare two sentences here. Hey son, here is $10,000 for tuition. I'm going to, I want to help you on this. How we're going to do it is show me your tuition bill, and I'm going to give this $10,000 directly to WVU, right? So if we have like father who directly gives it to WVU, the 10 grand, that is not a gift. Compare that with, right? Father says, hi son, I'm going to give you 10 grand and then you pay WVU, use this for your tuition. That is a gift, right? So you got to read the words, the verbiage, careful there. Likewise, if there's a divorce, right? So husband and wife separate, and then, hey, we got to give the wife the house, or the wife's got to give the car to the ex. That's not a gift, okay? So how do we value these gifts? We've been talking about high level kind of the formulation with it. What is a gift? What's not a gift? The general rule for valuations of gifts, right? We're going to just say, what was the fair market value of what you gave, right? And in this framework, one of the things we got to distinguish is, are we giving a present interest or a future interest? Right? So as I have here, if the donee, the person receiving the gift, has the right to currently enjoy or receive income payments, then they have received a present interest. It's like an ownership type thing. I have a present interest in this parcel of land, right? It's like an ownership idea. In contrast, if the donee has the right to receive the income or property in the future, right, then the donee has a future interest. We will define these here as we move forward. But the idea with this is, at a general rule, with regard to present interest, right, we're going to be using the fair market value. If, however, somebody receives a future interest, the IRS has some special rules for this. They're kind of like complicated. But to keep it simple, you can just think we're going to, value that whatever that future payment they receive, we're going to shrink it down into today's dollars. Now, when we talk about future, value, present value, right, that's going to come into play like we've seen in the past with time value money. When we talk about present interest and future interest, other things we got to be aware of, or kind of definitions here, are if you have a terminable interest, if it's a life estate, and the difference between remainder and reversion. So what does this mean? Right? Well, a present interest may not last forever. If the current right to use the property is for a specific length of time or until a certain event happens, then it is a terminable interest. It is capable of being cut short. One type of this, right, if the owner receives the right to possess or receive income for the durations of one's life, that is a life estate, which is a type of terminable interest on here. At the end of a terminable interest, the property may transfer to a new owner. In this case, the new owner is known as a remainderman and has a future interest of a remainder. Alternatively, at the end of a terminable interest, the property can return to the original owner. In this case, the original owner has a future interest of a reversion. Okay? Here's the setup, right? We're going to have, right, we're going to say they have a gift, right? That's a gift, to daughter for life, then to grandson, right? What's going on here is daughter is going to have a life estate. She now owns, has a present interest, right? So she has a present interest in the gift, right? And it's a terminable interest because it's a life estate. She gets it for her life. Thereafter, right, it's going to go to grandson over here, right? Grandson has a future interest in this, right? If you're like grandson, right, you're looking out of his eyeballs, right? He's seeing this. I don't get it right now, but I get it in the future. And in this way, right, because at the end of the terminable interest, when she dies, it goes to a third party. That type of future interest is known as a remainder, right? And in this way, right, grandson is actually going to be a remainder man. It's more like remainder baby, but the legal term is remainder man, right? So that's the setup there. Compare that with, right, two daughter for life and then back to me or something like that, right? Daughter is going to have a life estate, right? And father here, right, he's going to have a future interest of whenever she dies, right, instead of it going to a third party like the baby, it reverts back, it bounces back. He's going to have a reversion, right? So like we said here, right, a present interest, it's capable of being cut short. A life estate, then they die, right? That's a terminable interest in there. At the end of the terminal interest, when they die, that property could be transferred to a new person, baby, right? Baby is going to have a future interest, and that's known as a remainder. What their interest, like the actual, like, you know, my interest in that gift once mom dies, that's a remainder to me. If it, right, life estate, if she dies and it bounces back to father, right, he's going to have a future interest in it known as a reversion. And looking at this, right, let me find the example on it. There's the example. 25.3 I'm hunting for. Where's it at on here? Oh, okay, here we go. One of the things we got to keep in mind is, right, with regard to future interests, right, that remainder to baby, right, we need to put a value on that. And because that's in the future, right, we're going to have to shrink it down into today's dollars, right? So let's look here at 25.3. So we have a taxpayer, they put $500,000 of trust into a stock. The trust is to pay TP2 for life, then remainder to TP3, right? So we're going to have father is going to give it to daughter for life, then to baby. At the time of the gift, right, daughter is 35 years old, and we expect a 5.8% rate for using the IRS chart on this. How do we figure this out, right? We got to put a number on this gift, right? Well, if we go over here, right, the remainder, right, so George, right, that's going to be baby, right? They're going to do $500,000 times 0.18892. So we're focusing on baby first. Right, we're trying to put a number on the future interest here to value it. Right, so baby, we're going to do this. And it's a little bit wonky here, right? Because we're going to take the 500,000, we're going to multiply it times 0.1182 using this chart. But the chart here, right, when we use the chart, we have to reference daughter for the chart. So it's kind of weird. You have to go over here to daughter, use the chart to help us figure out baby. Right, so when we do it, right, it's 5.8%. The daughter is 35, right? There's the percentage, 0.1182892, right? So we do 500,000 times 0.1182. That means when we put a number on it, there's 59,000 roughly for baby. If we were to, shrink this down, well, we take the 500 minus the 59, 440 is going to be the remaining value for that life estate to daughter. Right, so 440 here on it. Maybe 441 if we want to round it up to, 500. Right, I'll just put 441 just to show you there. Okay. So thus far, right, we've talked about what is a gift, what's not a gift, how to value a gift, right? So knowing all of this, we should be able to kind of collectively say, hey, here are our total or gross gifts. Once we determine our kind of gross gifts, then we got to make some adjustments to arrive at our taxable gifts. Right? We care about our taxable gifts because those are the ones that are ultimately going to be subject to tax, right? It's like, there's a difference between your gross income on your tax return and your taxable income. The taxable income is more important. All right, so we kind of have our gross over here, just like the total of all those gifts. We back out, I'm just going to put AJEs, adjusting journal entries, to get to our taxable gifts. We will talk about these, right? I'm not going to belabor them right now, but essentially some of them are statutory exclusions, right? So for certain things, and it depends on how you do this, but one of them is the annual gift tax exclusion, right? $17,000 per year. Marital deduction for any transfers between husband and wife, unlimited charity, so any charity on there. Let's kind of look at these, right? So let's start here with this annual exclusion, right? Maybe we have $100, 100,000 of gross gifts, but then we're going to start backing some things out on that. The first one here will be the annual exclusion, right? This changes every year, right? For 2023, it's 17,000. But the idea with this is you can use this for each donee. In other words, it's not $17,000 total for the year, it's for each person, right? It's like Oprah, if you remember from the 2000s, like you get a car, you get a car, you get a car, you get a car, right? It's like you get 17,000, you get 17,000. So hypothetically, right, given that framework, a donor could give 17,000 to 10 people, and they wouldn't have any taxable gift because for each of those people, they get to back out $17,000. Right? One thing to be aware of here is that this annual exclusion of $17,000, it only applies to gifts of present interest. Stated alternatively, you do not get the exclusion for gifts of future interest. There is an exception there if you're a minor. Okay, so let's look at 24.4 and 24.5. Okay, TP1, they make a life estate gift to TP2 with a remainder gift to TP3, right? So let's just say father gives a life estate to daughter, and then it goes to baby, right? What's going on here, right? Well, how many, right? So if this is father right here, their gift return. Oops, sorry. What we need to look at is each of these people, right? Because he gave a gift to daughter, right? He gave a gift to baby, theoretically. For daughter, right? We valued this, right? We looked at that $500 and we broke it out in the last example, roughly 441 and 59, right? Like 441 and 59. Right? See this lecture like 5 minutes ago. This right here, to daughter, that is a present interest, right? Accordingly, right, she's going to get the annual exclusion for it when we look at our gifts to daughter on that. Baby, however, right, we said baby's interest, that remainder is a future interest, right? Future interests do not get the annual exclusion, right? That's why it's 0 there on it. So that's, what these guys are saying. So essentially what's going on here on father's return, right? He made a $500,000 total gift, for which $17,000 is eligible for the exclusion. His taxable gifts are going to be $483,000. Continuing, right? One thing you should be aware is, right, in community property states, right, that's the minority of the states. If you have property that's owned by husband and wife, regardless of who bought it, the law says, look, hey, husband, you bought a boat, you put it in your name, you're married. Already we're treating that, even though you paid every dollar for it, we are treating it as if it's 50-50 owned, right? So say husband buys, I don't know, a truck or a car or something, right? That's like a really bad truck. Husband's like, look, I buy this truck for 50 grand. I pay every penny. In a community property state, that truck is going to be considered owned automatically 50-50 by husband and wife, right? That's the minority of states. In common law states, however, they don't follow that, right? One spouse can own a disproportionate amount of property in that state, okay? So one of the things here, right, because we have this configuration in a community property state where it's 50-50, if they were to gift this truck, right, they're going to get kind of a double annual exclusion for it. It's going to be treated essentially like two gifts, half of it from husband, half of it from wife. Whereas if it was in a common law state, right, it essentially would be a gift from just husband where there's only one exclusion on it. So what we have in order to kind of make this even Steven, right, to get this functional equivalent is in common law states, they have a gift splitting election that says, hey, husband, right, you can make an election to treat this gift as if each spouse, you and wife, made the gift, right? So there's some criteria to this. Let's look at 25.6, just to look at it with some simple numbers. So looks like husband and wife live in a common law state. Looks like here that taxpayer 5 gives $35,000 to taxpayer 4 and $41,000 to taxpayer 2. What are the amount of taxpayers 5's taxable gifts? Right, well, if you were to essentially take each one of these, back out the annual exclusion, right, it's going to be $18,000 to this guy, right, 35 minus 17, and $24,000 to that person, right? So add those together, 42 total, right? So this is just saying that, hey, just wife gives the gift, right, with on it, right? And this is common law. Now, say in that common law state, they're like, look, we are choosing to elect to split gifts. So now it's going to be, even though, wife theoretically owns all this property, we are going to treat it like husband gives the gift and wife gives the gift 50-50. When you run the numbers on this, right, and you apply the annual exclusion for each of them, for each gift, right, it's going to result in $8,000 total, right? So you can see how powerful this is, the gift splitting, if you want to mitigate your gifts. You can look at the math over there on it. Essentially, what we're doing here is, if this was a community property state, right, the minority of states, the automatic setup is this, right? This is the default. It gets you to that 8,000. Here, right, in a common law state, the default would be 42,000, but if you elect to split the gifts, right, it essentially gets you to the same treatment from a common law to a community property, 8 and 8. All right, marital deduction, right? So if this is like, husband and wife, right, gifts between them, right, you're going to be able to get a deduction for that. There are kind of two limitations, right? Whenever you quantify this, you first have to apply the annual exclusion, and then terminable interests between spouses do not qualify for the deduction in this case. Let's look at 25.7. Husband gives wife $50,000 of jewelry. Thing here, right? How does this work, right? So first thing is we got to apply the annual exclusion, right? Minus 17. So if we were to look at this, right, that would get us, 40, 50, 33. Okay. Then what we do is, right, so annual exclusion first, then we get out the marital deduction for 33, right? Takes us down to 0. That's what this slide is saying here. Hey, yeah, we have a marital deduction between the spouses, right? This is applied after the annual exclusion. In other words, we did 17 first, then the marital deduction. The second point here says, okay, husband transfers $200,000 to a trust, which will pay wife for life, right? So husband essentially is giving wife a life estate, right? With this, right, they want to know what is the amount of taxable gift if at the time she's 38 and there's a 5% rate. So if we were to use that table from before, but what it says here is terminable interest between spouses do not qualify for the marital deduction. Here, the terminable interest is a life estate, right? So if we look at this, right? So if this is, wife right here, we gave her, in this case, oh, and we're going to have baby in the fray here, right? Let's see here. At the death, the remainder passes to TP2, so just the third party, right? So when you do the math on it, it's a different number, right? It's like 200, right? You're going to use these factors, right, based on the wife, but then you do baby and then you back into wife. See the lecture earlier, right? We break it out something like 165, 35, right? See the lecture earlier for that math. Idea with this, with wife is, right, you get the annual exclusion there, but you do not get, because it's a life estate, the marital deduction. For baby, right, we talked about this, because it's a future interest, you do not get the annual exclusion, and baby is not your husband or wife, so you're not going to get the marital deduction for that. Charitable deduction, let's talk a little bit about this. Right, so if you make donations to a 501c3, you can get a deduction for this. Again, this is going to be after applying the annual exclusion. Let's look at 25.8 on this. Taxpayer 1 gives $1.55 to State University as a gift, right? Charity, let's just say they're a recognized 501c3. Back out the annual exclusion first. The leftover is the charitable deduction, $0 of taxable gifts. Okay. 25.9 just kind of shows, you can read this like the cumulative gifts on this case, how we're going from kind of gross gifts to taxable. It's combining all these like previous examples we've seen. And then if we were to, right, if I were to pull this guy down just to kind of rehash where we're at in this. All right, we talked about gross gifts. We talked about the annual exclusion. We talked about the deductions, right? This is where we're at right now, taxable gifts. What we're going to do is once we get those taxable gifts, we're going to add prior year taxable gifts to it, this guy, right? Then we calculate tax on total gifts using the current tax rate, right, down here. And then it says, while the tax paid on prior gifts is ignored, it ultimately is going to be subtracted from total gifts. That is to say, it acts like a credit. However, be aware this is calculated using the current tax rates. And then finally, it says, right, the last adjustment in the formula is to figure out the unused portion of the applicable credit. One of the ways you can do this, right, we said there's a relationship between the applicable credit and the exemption equivalent. Sometimes it's easier to just use the exemption equivalent on this, but essentially what you do here is you're going to back that out on it. So let me kind of go back. Right, so total tax paid on prior gifts, blue, that's this guy. And then green, we're going to use the applicable credit. This guy, right, this is like, this applicable credit is what basically makes this pointless to study because it's like $5 million. Okay, so let's look here at 2510, 2511, and we can wrap this lecture up. So this is giving it some numbers, right? We start with current year taxable gifts. So we went from our gross gifts and we figured out what were our taxable gifts, 582. We're going to add to that prior year taxable gifts, right? That's cumulative taxable gifts of roughly $2 million. We figure out the tax liability on that using the current year tax rates, right? So on this 2 million, we owe 778. We back out from that the current tax liability on prior year taxable gifts, 545. That will give us our tax on current taxable gifts, 233. Oh, look, the applicable credit comes in, that takes us down to 0, right? Gift tax due. So even though we had to file a gift tax return, right, to basically keep a record of essentially, how much of this applicable credit we've given, right? We're kind of tracking how many taxable gifts we've given, right? We don't actually have a tax liability, right? So this is like whenever people are like, I can't give a gift above 17,000, well, because I'll have to file a gift tax return. Well, that's true, but it doesn't mean you're going to have a tax liability, right? So essentially, what they do here is they look at that exemption equivalent. For the current year, it's 12.9. In 2007, from your prior gifts, right, it was 1 million. Your current year taxable gifts, right, were 582, right? That's going to give us the remaining unused exemption. In other words, this 582 is connected with the 233, right? It's like this is the amount of gifts that produce that much credit. Okay, so you can see, right, like this would be really hard to give you some formula and have you test it on this. It's like very, very complex. So I'm more concerned that you're aware of and can do like the blocking, the tackling, kind of just like simple adjustments, right? Like, oh, okay, here's gross gifts. Please tell me taxable gifts. How about this deduction? What is the purpose of the applicable credit, right? These kind of like fundamental type things. All right, so I'm going to end the lecture here.